The first thing I wanted to do is thank you guys for coming. It's certainly an honor to have you here, and so thank you for coming. And then I also want to thank a couple of people. First of all, I'd like to thank Casa and Morelos. They were kind enough to just allow us to use this space when I found out there was going to be more people coming than would fit in my office. So they were very gracious about that and just allowed us to use the space. The other thing is I'd like to thank Mr. and Mrs. Carl and Debbie Dangle. They are actually the people that put me in contact with Stuart, who's going to be this guest speaker tonight, and so they were kind enough to give us the referral, and so we're all looking forward to hearing from him. And then, as you guys know, we have a weekly, I just wanted to pass this along in case you didn't know, we have a weekly workshop that goes from December through April, every Tuesday night at 5 o'clock. This happens to be sort of a special edition with a guest speaker, but usually the topics that we cover are how to buy in Mexico, how to own, how to live here, retire here, work here. And so if you guys have company or something that comes and you're tired of giving the spiel, you can send them to my office on Tuesday nights at 5 and I will do that for you. Okay? And so we do that every Tuesday night from December through April. And I also do it on special requests. So if they happen to be here out of season, it's just generally there's not enough people here that we do the workshop. But if there happens to be a group where you have some people in, please send them. I'm happy to give them the lowdown on how that works. Just a couple of housekeeping things. As you know, there's refreshments over here. Please help yourselves. There's water in the coolers below, and then coffee. Sugar is down here, so we're good. Cookies, please help yourselves. The bathrooms are over in this back corner here, so if you need to use the restroom at all, they're back there. And other than that, I'd just like to take the opportunity to, number one, thank Stuart for coming. And Stuart, this is Mr. Stuart Jackson. He works for the Jackson Group out of Georgia. They are certified professional accountants, and they also are very knowledgeable about the international topics that we're going to discuss tonight. So, Stuart has cards up here, and I have listened to the preview of what he's going to introduce tonight, and I will tell you that it's certainly worth, if you have any questions, finding a professional, Stuart being definitely one of those professionals to assist you in community help with any of the forms. There's been a lot of changes, and he's here to update us on the very latest news about those changes. So, with that, I am going to turn it over to Stuart. One last thing, we are going to be videotaping this. And so, number one, you're all extras in a YouTube video. And number two, I am going to post this in sections. I don't think it's going to let me post it all together because of the length. But I'll be able to post, part one of however many, two of however many. And so this, I plan to post this later on YouTube. And if you follow the blog, which is portamorelosblog.com, I will be posting the links to that as soon as I get everything loaded up. So if you keep an eye on portamorelosblog.com, it's my blog, so you should be reading it anyway. But if you're not already, keep an eye on it, and I'll be posting the links as soon as I get the video loaded online. Okay? So with that, I'd like to thank Stuart for coming. And, take it away.
As Amber said, I'm Stuart Jackson. I'm a CPA out of Atlanta, Georgia. So I don't think my accent's too heavy, but some people believe so. I'll try to mumble. Let me know if anyone can't hear me. I don't know how the sound carries over there. My firm is the Jackson Group. It was started by my mother. My mother and Debbie have been friends for a long time. We've also been friends with them for years as they lived in New Orleans and moved down here. They also talked my family into buying some land. We've got some property out on the Ruta de Cenote, which hasn't been developed yet. But I want to start working my way from spending so much time in Atlanta to a little bit more time down here. And just finished tax season on April 17th. Just got down here on Sunday and I've been sleeping most of the time. So maybe a little bit foggy on some of the things we talk about, but I try to be clear. I try to do an outline here. I'm going to discuss a lot of items that seem to have been brought up by Amber and other people that people might have questions about. Mainly first disclosures, assets and things like that. About having a house in Mexico, whether it's a principal residence, secondary vacation home, or rental property, or a mix of all those. There's lots of different codes and requirements for each one of those. Selling of your property down here in Mexico, what the tax impact is going to be on your U.S. tax return, and how you can use your credits, tax paid to Mexico, as a credit on U.S. return. I don't want to go to too much detail on all these things. I'm just trying to do an overview of all the items. Like I said, I know a lot about a few of the things. I know some stuff about a lot of it, and I know very little about some of it. But what I want to mainly provide y'all with is an overall understanding of the different tax aspects on your U.S. tax return with relating to owning property and living in Mexico. Also, maybe give you some buzzwords, forms, things of that nature that, so when you're talking with your CPA, either if he or she mentions it, you understand what it is, or you can bring it up to them. So I've done an outline here, and as I was working on the outline last night and this morning, I realized there's a lot of information to go over. I want to kind of keep it about 30 minutes and then time for questions. So we'll just go through. As I said, the main thing right now, there's new changes in the tax code for 2011. If any of y'all are full-time residents out of the country, you have your automatic 2-month extension to file your tax returns from April 17th to June 15th. In addition, there's the standard 6-month extension just to file your returns. But one of the new changes for 2011 is the Form 8938, which is a statement of specified foreign financial assets. This is a form that is very similar to the TDF 90.22-1, which is a form that the U.S. Treasury has required for years for anyone to disclose of any foreign financial accounts that have $10,000 or more. For years, as a result of UBS and these other offshore accounts and people not reporting their income, the assets or the income coming from it, the U.S. Treasury came out with this form also to try to trace any type of money laundering, terrorist forms of that nature. Well, that form, which if you have any accounts over $10,000 or signing authorization to any account, for anybody, those forms need to be filed every year if you have $10,000 or more in them, and they're due June 30th. As I said, this form, most people believe is an IRS form. It's actually a U.S. Treasury form. U.S. Treasury does not provide that information to the IRS. That's why the IRS came out with their own form, which is the 8938 this year. But it does have higher thresholds of disclosure, whereas the 90-22.1 is the which is the FBAR statement. It's easier to say than the whole number of it. As I said, it was a $10,000 or more maximum balance in the account anytime during the year had to be reported. The 8938 now has, if you're a U.S. resident living in the United States as your primary place, it's $100,000 or $100,000 at the end of the year, or $150,000 at any time during the year. That's going to be all of your, the combination of all your specific foreign financial assets. Now, I do suggest that you look on the forms to see what actually needs to be reported on there. The main items are similar to the U.S. Treasury form. It's going to be foreign stocks not held in a U.S. brokerage account. It's going to be interest in a foreign corporation, interest in a foreign partnership, interest in a foreign trust, which brings us up to the situation in Mexico with U.S. citizens owning property down here. And I'm completely on blank on how to pronounce it.
Fideicomiso.
Yes, everyone else does. question is that need to be reported on the 8938? Well, the 8938 specifically says on there, if you have already reported certain foreign financial assets, interests in a foreign corporation, partnership, or investment company, which are the forms 3520, the 3520A, the 5471, the 8621, the 8865, the 8891, which are all listed on here. You do not have to report it on the 8938, but you have to disclose on that form that you reported on the other form. So there's a section, section 4 of the 8938 has a list of which of these other forms you filed, how many of them, and so it's a cross-reference. As I said, this form 8938 came out this year. It's reporting the exact same information that you're reporting on your FBAR forms, U.S. Treasury. It's just the U.S. Treasury doesn't give that information to the IRS. Congress is trying to work on the next couple of years to combine those forms, so that it's just one form again, instead of adding on these additional forms. Questions about Mexico and having your house in the trust, whether you need to report it on the form 3520A, the annual information return for a foreign trust with U.S. owner. We ask around, some people do, some people don't report it. If it's just a residence that you have and it's not generating income, there's the interpretation that it doesn't need to be reported. My personal belief in all these type of forms is if it's informational and you're just providing it, you're not trying to hide anything, file the form. It gets the statute of limitations going, in Congress, if you have it filed, do it. It doesn't take too long, especially the 3520A, which is for the foreign trusts. You basically report all the income and expenses of the trust assets. Well, if it's your private residence, there is nothing, so it's basically a zero form. I would just suggest to file it. You have other issues with the other forms of foreign partnerships, especially the 8865. I see that more of people owning property in Costa Rica. They'll set up a foreign partnership with their friends because they bought a house down there. That's another type of form that needs to be disclosed. If it's just used as a second home, vacation home, it's going to be zero. If you're reporting rental income, well, you need to report it anyway. So you report on that form, you're going to report it on your U.S. tax return also. Are there any questions about this?
What is the difference between the 3520 and the 3520A?
3520A is just the actual return of the foreign trust. It's kind of has a balance sheet, income statement.
Okay, so you actually have to file both of them?
The 3520 is if you take distributions, if you have distributions taken from the trust.
Okay.
If you, another example that's specifically in the instructions is if there's a credit card account tied to that trust in a foreign country and you charge personal expenses on there, that's considered a distribution. And also the form is if you've got a non-U.S. resident spouse or relatives and they give you gifts over $100,000,
Okay.
it needs to be disclosed.
But basically, if I have a private house and it's not really generating any income, I'm just using it, I just have to report it on 3520A.
A is the main form.
Okay.
When you say trust, you're talking about the people for this one?
Right.
Yes.
So
Yeah.
we're supposed to, what are we supposed to file with? I mean,
You're just disclosing that you own a property in Mexico, and that's it. Because the form, you have to report these if there is at any time going to be a possibility of income, taxable income in the United States. And when you sell the property, there would be a gain that could be taxable in the United States. So the fact that you're not reporting it every year, IRS and the U.S. Treasury is really trying to go after the people that are hiding assets, trying to hide income, those type of things. I haven't really found any type of case in tax court going after somebody with property held in this type of trust because it's really kind of a grantor trust. It's just required by the Mexican government to hold it. as an entity. You have the same thing in France with there's a type of French corporation, the SASE, that people put their personal residences in because it bypasses the French law, which requires the children to inherit homes. So if you don't want your children to inherit your house in the south of France, you put it up in this corporation. The corporation doesn't exist under the IRS rules, but you just file it anyway, just to acknowledge it. My feeling is just report it and not worry about it.
On the bank account, you're saying that anything over 10K is supposed to be reported?
If you have a foreign bank account and at any time during the year, the value of it is about 10,000 US dollars, it needs to be reported on the FBAR return.
And what about, then you said, but if you're living in the States and
And then that's for the FBAR for the US Treasury. Then there's the Form 8938 that just came out this year, which is the IRS return, the IRS form. That one is if your combined foreign assets are, for a married couple, above $100,000, then you have to report it. So it has a higher threshold. If you are a U.S. citizen living outside the United States for more than 330 days out of the year, then the threshold is actually raised to $400,000 couple.
what about a single?
It's half of that.
Stuart, just to clarify that, on the 8938, when you say foreign assets, like, for instance, you mentioned trust. So if your house is worth, even if you don't have bank accounts, but if your house or your property is in trust and it's worth a market value of over $100,000, you should also be filing that form as well, correct? Am I understanding that correctly? Talking about the 8938.
Is you have to file that form, but not report the trust, but you have to file the form to acknowledge that you have filed the 3520A.
3520A.
Correct.
Oh my gosh, okay.
Yes.
Got it.
That's
I'm
why.
filing the form to tell them that I already put it on the other form.
But it's, there, if you go on all the blogs, I mean the IRS website, the IRS website has got good information about it, trying to explain it. They really haven't come up, every month or so, they're coming out with a new notice and clarification on this.
Sounds like
You really don't have to file the 8938 if you only have an asset in the, that you've reported on the other ones. It's as if you have to file it. If you've got something that's not held in a foreign trust or a foreign partnership, those things of nature, and you're reporting the 8938, then you would report
Okay.
that you have filed the 3520A. So that's why it's a nightmare. Nobody's really happy about it.
All right.
When you say report the fideicomiso on the 3520A,
Mm-hmm.
is that an appraised value or you're just saying you got a fideicomiso?
Current fair market value.
Fair in whose eyes, the Mexican government or the,
Whomever.
okay.
It's not clarified. So, most all of the IRS code is, it's a bunch of congressmen who've come up with a bunch of ideas to help them personally with their particular situation, but they didn't clarify how it's going to help everybody. So it's kind of a hit and miss going on. As this form is filed over the next few years, there's going to be clarifications of what actually is required to be filed. Two things are specific that don't need to be reported for foreign financial assets. Things if you own them outright are currency. If you got a hoard of cash in your house, or a gold bullion or coins, those type of things.
Those do or don't?
Do not have to be reported if you're holding them in your house or your safety
Okay.
deposit box. If you're holding them in a brokerage account, a foreign brokerage account, you do.
Okay.
But on the other hand, if you're holding a bunch of gold in your house, you do have to report it on the
The other
FBAR
one.
return.
Yeah.
Yeah, one way or
The treasury, you have to report it.
Right, so the Treasury wants to know if you're hoarding it because it could be a terrorist. The IRS doesn't care unless it is going to generate a bunch of tax.
Okay.
Yes, sir.
We own a couple of properties in Mexico. We formed a Mexican corporation and purchased them through the corporation. And is this the same for us?
Well, for your Mexican corporation, you're gonna be filing the 5471 every year. Disclosing that you're a U.S. citizen with interest in a foreign corporation. So then, you wouldn't have to file the 8938 because you're already reporting on the 5471, unless you had something else, you had some foreign stock that was not being held in a foreign account or a U.S. account.
So just a couple of residences, all we do is report the corporation without.
Right. One time that the Mexican taxing, people believe that for a corporation, property should, or a corporation should be generating income or expenses. Do you have them as rental properties in the corporation? So the same thing, it would be just disclosing them as assets. You know, these disclosure forms are similar to U.S. ones, you know, balance sheet and income statement. So you report the assets on the balance sheet, on the no income or expense.
Okay, so you have property on Ridge Basin, it's just property, it's just sitting there.
It's just
So
land.
what do you report? What do you do?
We don't have it in I think so.
You have it through a Mexican corporation?
No.
You have a Mexican wife?
No. We have it in
Your Mexican attorney told you.
yeah, we have it in a different,
It's a Hito property.
Ejido property
Oh.
right now. So, we're not.
So they can
reporting.
take that away from you almost any time.
Right, exactly. That's why nothing's on there. When that changes, you know, development will come on. So, carry on to the houses, you know, you can have your principal residence, your vacation home, second or third home, a rental property, or all the above. I don't know, I guess most people here probably have their house as a second home here? Or first home? Okay, first and only home, all right. So for principal residence, you're here most of your time. When you sell it, you know, there's gonna be a gain or a loss, hopefully a gain. You know, the gain on the US tax return is gonna be calculated by the purchase price, all the improvements that you put into it, or the purchase price minus you have your selling price that you sold it for, then you subtract that, your purchase price, your closing costs, the sale of the expense of sale, and your cost of your improvements. I believe.
But you have to have receipts for all of it.
Correct. You have to have receipts for all of it, and then you have to calculate the U.S. value of the exchange rate of that day that you spent the money. So,
I built my house 16 years ago.
right.
Here.
So you're going to go back and perhaps,
I live here 365 days a year.
so when you sell it, most likely, if it is just you in the house, there's a $250,000 gain exclusion on your primary residence.
Well, I don't plan on selling it, it's my only home.
Okay. If you were to,
My daughter will sell it, maybe 70 or 100 years from now.
wealthy man comes in a boat, sweeps you away. And says, live on my yacht for the rest of the time. And you sell it. But if you were to sell it, like I said, there's $250,000 gain, the Section 121 gain for your primary residence. You know, this does in the United States too, and it is allowed for your foreign residence too, as long as it's your primary residence. $250,000 per taxpayer. Taxpayer spouse or two individuals that own the house together. As we get out here in the lower section, talking about housing.
How often can you do that?
Every 2 years. You have to live in the house. It has to be your primary residence for 2 out of the prior 5 years. You have to own and use it as your primary residence. There are some twists and changes that I put in there. You can convert a primary residence to a rental property, and then as long as you sell it within the 5-year period, you can get 100% of the $250,000 exclusion, or 500,000 for a couple. If you do it the other way, you convert a primary residence to a rental property, the years after 2008 that it's rental property, you don't get the exclusion for that portion of it. I'm not going to try to explain all of it, but just know that if you convert your primary residence to rental and then try to sell it a couple of years later, you're not going to get all $250,000 and $500,000 of exclusion. Also, the other way, if you have rented it out at any time and taken a depreciation deduction on your property, the amount of depreciation deduction that you've taken on it, that was a deduction on a prior year's tax return, that doesn't get excluded, so you have to pay tax on that.
Is that applying to also residents in the States? Is this the same?
It's the same in the United States and foreign real estate property. This so. If you want to get more information about that, it's publication. Publication 527 on the IRS website.
527?
You just Google irs.gov and Pub 527. That's going to give you.
Converting a principal residence into a rental.
It's going to explain. It's about 70 pages and it explains all of the situations. But here's good examples of having a primary residence and selling it. Primary residence, but only living there a year and a half because your next door neighbor is a criminal and has been threatening you. You get the full exclusion. There's all, as with anything with the IRS, here's the law, and then here's 50 exceptions. So going back to the things, your principal residence, the main thing with that is you get your $250,000 gain exclusion if you were to sell it. And you lived in it for at least 2 years, you get to deduct your real estate taxes and your mortgage interest. Of course, on here I say a portion of your mortgage interest. There is the rule that you can only deduct the mortgage interest on your first $1.1 million of acquisition debt on your first 2 homes. So you buy a house down here, or you have a house in the United States, you buy it for $1 million. You buy a house down here for $500,000, you finance a portion of it, you can only deduct up to $1.1 million, the ratio of up to $1.1 million of the acquisition debt. So you've got $400,000 of acquisition debt that the interest can't be deducted on. That's another formula that I'm not going to try to explain without a board. But just know that you can't do a third home. You know, a lot of people, you have a house in Georgia, in Atlanta, you have a house in Hilton Head Island, and you buy a house down here. The third house, you can't deduct any mortgage interest at all. And you can't deduct mortgage interest above the $1.1 million. Then you've got, but there is the, speaking of Atlanta, there's what I call the 96 Olympic rule. If you got a primary residence and you rent it out for 14 days or less during the year, and you get rental income from it, you don't have to report it. The rule came up right before the Olympics in Atlanta. So you got a big event coming into your town, you rent out your house and you go on vacation, and you rent it out for $5,000 for a week or 2, you don't have to report it. So that's one of the very few allowances in the U.S. Tax Code of not having to report income. Rental property, you've got, then there's the mixed use home. That's the personal use is under 14 days. Then you have a full rental property. Here's where it gets ugly. You've got, when your mixed use home, the whole rule of 14 days or 10% of rental days. If you've got a private residence, this is a vacation home down here, you use it for 14 days or less and rent it out for the rest of the time, it's considered a rental property, and you can deduct most all of the expenses. if you have a rental property down here and you spend 4 months out of the year in it, and then you have the rest of the time it's rented out to somebody else, you get to deduct a portion of it. So you have to allocate your expenses between personal expenses and Schedule E expenses. The rental income is reported on Schedule E, and then, as everyone probably already knows, Schedule A is where your itemized deductions go. That's where, if it's just your primary residence, you're going to report your mortgage interest and your real estate taxes.
Real estate tax.
Which aren't so high up here. I'll be beat. I paid $40 last year in real estate taxes in downtown Atlanta because I'm in an empowerment zone, which means no one wants to live there. I've tried to outline it in here, kind of where the income's reported on Schedule E, which one's reported on Schedule A. It's complex. What I do want to note on that greater or less than 14 days or 10% of days rented at fair rental value is the actual IRS code says 10% of days rented, but as you go through the examples in the IRS publications, it's really of the days rentable. Let's say you've got a property in Mexico or even in Florida. We'll use Florida for example because we have property down there, and after Katrina, first after Katrina and then the oil spill, nobody wanted to go down to the panhandle of Florida, even though it's far away from most of the destruction. So we had a rental property on the market for 8 months, but we're only renting it out a few weeks out of the 8-month period. According to the strict wording of the IRS code, it would only be 10% of those 8 weeks rented. But actually, if you read through their example, it's days rentable. So you get into the market for 8 months to rent it out, then when you're calculating this 10%, you get that full 8 months, in my opinion. So it actually would allow you more than 14 days to use it for personal use. Also, as we're discussing with Amber, this discussion of personal use of 14 days. If you go down with your family down here or to Florida or with your rental property anywhere, you're working all day painting, fixing all the problems that are there, and your kids and the rest of the family are all playing in the water, it's considered a maintenance day. It doesn't go towards those 14 days. So the 14 days are 10%. So when you're going down to use these properties, you want to stay within that parameter of 14 days or 10% of days rented. Do work, keep your receipts, document that you were there sweating and toiling while the rest of your family is enjoying your sweat and toil and the money spent. Any questions so far? I know it's convoluted, it's crazy, but that's why we have CPAs, I guess.
I assume if you had a property sold for profit down here, that the Mexican government is also going to want some part of that profit.
Correct.
Is there some agreement between the Mexican government and the U.S. government as to how that's divided?
Yes, we can work our way on down to that, about the U.S. Reporting of the sale of your house. When you sell your property in Mexico, the Mexican government's going to want, I guess the notario calculates what the gain is for the Mexican government and taxes you either 30% or 5%, depending on your status. Now the difference between the way the U.S. you would report your gain on your U.S. tax return and Mexican tax return is, from my understanding, is you have a stated value when you purchase it, and then there's a cost of inflation allowance that increases that value over the years. So your basis is increasing for that cost of inflation increase. And they only allow a certain amount of improvements to be added to the basis of the property.
You said you're taxed at 30% or 5%. What
Yeah,
is the
depending
difference?
on your status.
Yeah, explain that.
That's in Mexico, that's probably
Right.
more, okay,
This is the Mexican
so
portion?
so basically, when you sell your property in Mexico, there's gonna be a capital gain. Hopefully, if you have hopefully sold your house or your property for more than what you bought it for, there's gonna be a gain realized, and that gain is taxed. In Mexico, they calculate the capital gain, so I can speak to how they I can speak to how they calculate capital gain in Mexico, and Stuart's gonna explain how they calculate capital gain in the States. But know that those two figures are different. So the way they're gonna calculate capital gains in Mexico is, let's say you buy a property for $100,000 20 years ago, and you go to sell it today, all right? What Mexico does is, we were using the example, say you paid $100,000 for something in 1980, and in 2012 you're gonna sell it. And let's say I sell that property for $200,000 today. All right, so I have a sale price of $200,000, and I bought and I reported that I paid $100,000 in 1980, okay? What happens in Mexico is Mexico says, all right, well, since you're selling in 2012, $100,000 in 1980 was worth a whole lot more than $100,000 is today. So they adjust that original purchase price for inflation. There's a scheduled rate of inflation that notaries use, and they adjust that value up for inflation, which is a good thing because it works in your favor when you have a long-term investment. And Mexico is one of the only countries I know that actually does this, but they do adjust it for inflation. So without knowing the scheduled rate of inflation, I'd be willing to say that probably $200,000 in 2012 is probably $100,000 in 1980 or less, right? But let's say for the sake of the example, it's $190,000, okay? So $100,000 in 1980s dollars is equivalent to $190,000 in 2012 dollars, for the sake of this example. You would take the $200,000 that you're selling for, minus your adjusted purchase price of $190,000, you realize a gain of $10,000. That gain is taxed at 30%, okay? You do not get an exclusion for primary residence at this point in time as a foreigner. That may be changing, but at this point you don't. So you get taxed on that gain, that portion of the gain, at 30%, and you're allowed to deduct various things. You're allowed to deduct capital improvements if you have the facturas for those improvements. You're allowed to deduct some of your original closing costs when you bought, and you're allowed to deduct real estate commissions. And those are the three deductions you can take against that capital gains.
Commission?
Real estate commissions. Yeah, you're allowed to deduct capital improvements in your property if you have the facturas. Capital improvements are things that improve your property. So if you fix a leaky sink, that's not a capital improvement. But if you've put in new tile or added an addition or things that add real value to your property, those are deductible, providing that you have the facturas for that work. So that's how you calculate gains in Mexico. So the gain in Mexico is going to be one number, and then Stuart can talk about how that you can actually, there are other deductions that you can take in the States. And so your capital gains is figured in a different way on the US side.
Right. You went over that example. I believe the Mexico improvements, is it limited to a percentage of the value?
It's, no, but it is limited to what you can use. Like, for instance, if you add a new kitchen, it doesn't include contents. So, your appliances and things you put in don't count, but your countertops and things do. And things that add real value to the house as far as new tile and things like that. But replacing air conditioners that were already existing in the house is just considered maintenance.
Right.
So it doesn't really add real value. Whereas if you would add on a new room, that's adding value to the property and that's deductible.
Okay. Well, that's similar. But for using that example, so you bought the house in 1992 for $100,000 and you sold it this year for $200,000. It's a rental property. It's not your primary residence. It's your secondary residence, so there's no depreciation on it. Your second residence does not get the $500,000 exclusion. You have $100,000 that you bought it for. You sold it for $200,000. When you get to when calculating the gain, you have your closing costs when you bought it and when you sold it. you have your expensive sale, you spend any money trying to fix it up, putting in new landscaping, things of that nature, anything to make it nicer, you get to reduce that from the gain. And your cost of improvements. In the United States, it's pretty much that, but a little bit more. I mean, your appliances, your new heating and air conditioning, anything that improves the life or improves the quality. A little bit mood. That adds the basis, but there is not that adjustment for your increase, your inflation adjustment. So you'd have a gain on, say there was no cost, no commissions or anything, just to use straightforward, let's say the gain was $100,000. In the United States, the tax rate is 15% for a long-term capital gain. So you pay 30% in Mexico on a $10,000 gain. But in the United States, you're going to pay 15% on a $100,000 gain. So you have
25,000.
on 100,000, 15%, you pay 15,000 in tax. Well, what you do on the U.S. return is you report your gain and the tax on it, but then you get a foreign tax credit for the $3,000 that you paid to Mexico. And because and it becomes what an equivalent tax rate is. So when you report on the U.S. tax return, it's going to be on your Form 1116, is your foreign tax credit return. You calculate what your total tax is U.S.-wise, your ratio of foreign income over your total tax times the U.S. rate, and then you calculate what it would have been using the foreign tax. But it's not really 30%, it comes out to be 3% because you have $3,000 of tax credit paid, but it's on a $100,000 gain. So you actually get to use it all. So it reduces what you pay in the United States from $15,000 to $13,000, or $12,000.
So you're not double taxed, in
So
other
you're
words.
not double taxed. There are situations where if you were to sell it and you're in a country with fluctuating currency exchanges, it may come out a situation where a 30% tax here is going to be equal to a 15% tax in the United States. You may end up getting a full credit and not paying anything to the United States. You've already paid it to the foreign country. You know, Mexico, England, France, most of the developed countries all have tax treaties with each other that if you pay the tax in one country, you don't have to pay the equivalent amount in the other. But if it gets to the situation where you actually pay more tax to Mexico at a higher rate than the United States, you only get it up to the 15% in the United States. So let's say the situation ended up that there was no inflation adjustment in Mexico, and you paid 30% tax, so $30,000, over $30,000 to Mexico, and the U.S. tax is only 15%. You only get credit for $15,000. So you've got this extra $15,000 of foreign tax credit that wasn't used then. You can carry it back 1 year to try to offset other foreign income, or you can carry it forward 10 years. So if you sell another property or you've got foreign investments that are generating income, dividend, interest income, you may be able to use that in the next 10 years to offset that income. But a lot of times it just kind of goes away. And I've got a particular client who's been buying the right properties in the south of France and selling them every couple of years for about a $2 million profit. So you sell them to the Russians as they were coming in and buying up everything down there. France charges 33.3% capital gains rate on non-EU residents. So he's paying 33% to France. He gets $15,000, or 15% in the United States. So the last house they sold in 2003, next year, he's got about $100,000 of foreign tax credit that's paid to France, which is going to go away. But he had an earlier house that sold, and because going from French francs to the euro and exchange rate in the 5 years, it turned out that he actually got a whole bunch more and paid a lot less in US tax. So, probably going completely over your head, but there's this whole strange thing of the currency exchange that's built into your sale of your house. So if you think you might have sold your house for less than $500,000, based on what you kind of keep in your mind on your current exchange rate, if you go back 10 years and the exchange rate's different, it may throw you, because of that currency difference, over the $500,000. Or it may go the other way. All right, so I see a lot of glazed eyes. I know. I was trying to figure out a way to explain it all simply, but what I've figured out is all I can do is just kind of throw in some chunks of things to think about, to discuss with your CPA when the situation comes up that you're about to sell. But there's going to be issues of currency exchange, of figuring out how much your basis is based on, each year when you're putting in a new kitchen or addition on there, you got to do the exchange rate for each of those spot days. It may throw you down. You've got your property, you rented it for a few years but lived in it a few years. There's going to be issues of, do you get your $500,000 exclusion? There's situations where if it's rented half the year and you live in it half the year, you're going to be reporting your gain on 2 different forms. And you have to allocate all that income and all the expenses. I didn't even try to get into the fact that depreciation, when you depreciate a house, if you live in it full-time or partially, that gain is called an unrecaptured 250 gain, and it's taxed at 25% instead of 15%, which is the standard long-term tax rate. So basically, when everyone talking about tax reform, that we might need it, this is the perfect situation of being U.S. citizens living in a foreign country and having foreign assets, of the complexity of the rules. But since you're such a small minority of the voting constituency, they don't care. And most congressmen have never actually left the country anyway, or own properties. They don't understand the situations that arise from living in a foreign country, working in a foreign country. I guess that's kind of the main things I want to go over. So I'll probably caused a lot of questions. Is there anything else specific? Something to clarify? Yes, sir.
We have been running rental property down here for 20 years.
Mm-hmm.
And because the money was paid in the United States in an account, we have been filing income taxes in the United States as well as here.
Mm-hmm.
So I shouldn't assume, but all of this knowledge that we have, all these forms that have to be paid, to me, right now would be a waste of time.
If all of your money from the rental property is going into a U.S. bank account,
Yeah.
then you wouldn't have any foreign accounts to disclose.
Okay.
But if you have your rental property down here in a foreign trust, do you?
Yeah.
Then you have to file that form. Because it eventually will generate a gain because it's generating income and it's a foreign asset and a foreign.
Well, we also declare those trusts that we have to pay, the fideicomisos.
Right, you're reporting them on
that information.
the 3520A. You just
Well, I don't know what it is, whatever my
How
account
it does. Right. But if the income is coming into a U.S. account and it's in the United States, then you're not going to have to report on the FBAR return. Yes, ma'am.
All right, Mexico is going to know what I paid for the house and what I sold it for their calculations.
Correct.
How does the United States know? I have never filed this form, but I heard you say that if you file it, that I should file it for an asset based on the fair market value. Well, the fair market value today, of course, is different than 10 years ago, But then if I file it at today's fair market value and I sell it next year, then that's a much smaller profit margin.
Right, but for the US taxes, your basis is your purchase cost.
How do they know that?
Uh,
I mean, Mexico knows, but how
Right.
does the United States know? If the only piece of paper that I've ever filed is saying, you know, this one that's required now.
They're not. But if you were audited, because this property just appeared, and the United States says, okay, it's based on this fair market value from last year, but you had purchased it 20 years ago.
I'm wondering how they know any of these things.
They
You don't tell them.
They
I mean,
know.
because the first time they've ever asked me for anything will be this form.
Mhm. But, yeah, they don't know, they may not know, they may not audit you, but if you were audited and you had not disclosed the proper basis, and it was,
But if she has no finances involved with it in the United States, and it's free and clear here in Mexico, and even if they audit you, how do they know you have this property in Mexico?
Well, as of today, they don't.
Right, I'm going to say if they audit you tomorrow, how would they know you had property in Mexico?
Because you sign your IRS return on that, you say that it's a.
right, what
Sign
what I'm getting to is you're committing tax fraud, and it's a criminal offense, and you'll go to jail.
That's not it.
That was-
But unless you're a congressman, then you don't have to go.
Secretary of the Treasury.
Exactly, or you just go to Club Fed in Florida and take off.
Here, now I don't know about now, because I've been involved recently, but 25 years ago, even 16 years ago, when you bought or built property, and you took out the fideicomiso, the fideicomiso never states, if you're smart, never says the amount or
Right.
value.
Going forward, this is just another
And so
example.
there, cost, the cost of it, who knows? Nobody knows except the person that is.
Right, currently, just following the way that, the Swiss used to never acknowledge any bank accounts, everything was secret, now they've opened up every account to the United States. Things are moving, countries are becoming more transparent with each other. It may not be right now, but perhaps 5 years from now, US and Mexico, as more people live cross-border, this information may become required to be disclosed. With the 8938, all foreign entities that have US owners in them are also required to file these forms. So you have a foreign brokerage account, a foreign trustee. Actually, they probably, in Mexico, may be required due to this to start acknowledging the fact that US citizens.
They are actually, they're now required to report any bank accounts and fideicomisos to the US government.
Right, that's what I'm going to.
They are. Any bank accounts now that are owned by foreigners in Mexico and any fideicomisos, they are required by the Patriot Act to report them to the.
And if you don't, and if they don't do it, they're required to start withholding 30% of
Yeah, they start getting
income or the
fined.
assets each year.
But you're saying I can have up to 200K in a foreign bank account without retiring it.
Correct.
Okay, so how much?
For IRS, but for US Treasury, it's 10,000 pages. It's,
Okay, my husband and I built, if we file a 3520 and I assign a value to our house, which I'm not sure what it would be at this market, is that number gonna come back to haunt me when we sell and it's wrong
No.
one way or the other, or up or down?
no, because
Or gonna-
for the US tax return, it's purely based on the value, either your acquisition value, what you paid for, or your cost of building it, versus what you sold it for. So the annual variances of fair market value have no effect on it.
So, okay, now like other people around here, on our original value of what we bought the land and what says on the papers is two different things. I think other people kind of hinted at that, but anyway, so I should go buy pretty much what we have in US money into our house right now, whether we have the facturas or not.
Yeah, the facturas don't matter in the States. They're gonna matter when you go to sell as a deduction
Okay.
in Mexico. That's how
Okay.
you deduct your construction costs and your capital improvements in your property in Mexico.
Okay.
The US doesn't care about your facturas.
So pretty much put in there what we have into the house, not what I think the value is,
Yes.
one way or the other. Okay. If,
I mean, it's easy, it's not clear, you know, if it's not, you know, a tradable security or something that's got a market value on a traded market, it's not easy, and they acknowledge much. It's basically kind of figure out a way that you think it is and stay consistent each year.
okay.
It's basically, we were talking about this before, this is really just a disclosure notice. In our particular circumstances where we're just having these assets, they're just basically sitting, unless they are generating income, unless they're just sitting and it's your property. It's more of just, hey,
We've got
just
it down.
FYI, it's here.
Okay.
When they really care is when you sell, then you have to report that income. This
Right.
is more of just an FYI, it's here.
And we're talking with Carl too, like I said, they're just disclosures. IRS and the U.S. Treasury just wants to know, every U.S. citizen, wherever you live, you know, you have to report all of your worldwide income. And then and your assets, if they generate any type of income too. So you'll see on the 8938 on the second page, after you list what's on there, then on the second page, it's got a section that's like, okay, what form on your 1040 did you report the income from? Was it Schedule B for dividends or interest? Was it Schedule E for rental income? Those type of things. So if it's just your primary, secondary residence that's not generating income or type of thing, it does just become a disclosure form. And it is telling the IRS that eventually one day there's going to be either a sale, there's going to be a gain or loss from it being sold, or it's going to be an asset to be used in the calculation of estate taxes. So, you know, is it intrusive of them and they forcing you to disclose everything? Yes.
So it's included in, and if you fill out all these forms and give them in, and then it's included as part of your estate taxes?
Well, everything that you own is part of your estate tax anyway, whether it's in the United States or France or Mexico. The penalty for not filing it willfully negligent is a minimum of $10,000. So they're serious about it, but the main thing what they're trying to do is getting people with tax haven assets, offshore accounts in Caymans, Turks and Caicos. Switzerland used to be, now they've disclosed all their assets to the United States. When it's just a house, I mean, it's going to be something you have to report in your state anyway. And if you've got less than $5 million or $10 million for a couple, it's not going to be taxable anyway. But you know, are they forcing you to disclose everything you have? Yes.
Isn't it kind of like disclosing like a commodity, like you have a meat coat and they're making you say, well, I got this expensive, I know you aren't the IRS, well, I'm not, but I mean, isn't it,
Tell them about the story with the client with the gold balloon on.
Yeah, but, well, I mean, IRS is kind of making CPAs become part of them. And there's all these, you know, if we don't get copies of the letters for charitable donations, you know, we can't put on a tax return and sign it. We're the ones that have to say, you know, if you've got a rental property and you know, the 1099 miscellaneous that you have to pay to contractors and things of that nature. Starting in 2011, on the tax return, it's got for the Schedule C and Schedule E, did you pay anybody that requires you to issue a 1099 miscellaneous? And if you do, did you do them? You know? So it's, you know, we fill it out, and I think they did, you know. If they didn't do it, then they come back and hit y'all and they hit us. It's gold bullion with the F-bar return. It's just sitting in a Swiss account. You know, the Canadians and the Swiss have ownership of gold bullion through certain investment vehicles. Well, we just realized last year, she goes, oh, it was just sitting there, it wasn't earning any money, it wasn't doing anything. I just didn't think about it. Well, we had to go back 3 years and file the returns to the to U.S. Treasury to disclose that, and put on a footnote saying that, you know, the rules are confusing, but we've disclosed that the client has $60,000 of gold bullion in this foreign account, and it had generated no income, so therefore we request leniency on the $10,000 penalty. And we did, because it hadn't generated any income. She had not hidden any income. And even if she had sold some and reported on the tax return, then they wouldn't have the penalty either. You know, the $10,000 penalty or higher is mainly for the people that have foreign assets, that have sold something where it's generated income and they haven't reported it. You know, so I wouldn't be so worried about it if you're not, as long as you're reporting all of your income. You know, if it makes you worried at night, whether you should file it or not, file it. You know, is it, you know, back to what I said, is it telling them everything you have in an easier way that they don't have to make all the work? Yes. That's the way it is, that's the way it's going to be. And their countries are starting to speak more with each other, just like states. So I could go on a whole topic about nexus and different states taking income from people.
Well, filing this, do you think will maybe trigger though an audit?
No.
I mean, do you think any
As
more
long as you put
likely?
it, you know, for the foreign trust, you're disclosing, you make it clear that here's a property, it's our primary residence, it's not rented.
Yeah,
They're not going to spend their time and effort on that. But as she said, you know, I think Mexico's, they're having to disclose that all the other foreign countries that have a U.S. person, and a U.S. person includes an individual, a trust, a state, a partnership, and a corporation. So in IRS world, a person is any type of entity. So if you've got a trust that's a U.S. trust, and it's got these, you've got the house in that, or a partnership that's a U.S. partnership, you've got the exact same disclosure requirements.
So in the bank accounts in Mexico, and you receive money in pesos into that account, the Mexican banks automatically send that report to the U.S.? Is that just part of what they do?
Yes, the Mexican banks are required to report any U.S. citizens that have accounts to the IRS.
Any accounts are over a certain time.
And they do, no, it doesn't matter. They report any of them. And for instance, we've had clients where, because HSBC has dollar accounts, and the dollar accounts used to be in the Cayman Islands, and they still are, but a lot of them, they closed because the U.S., because of the problems that the U.S. citizens had with the Cayman Islands and things like that, they came in and there was a bunch of clients that we had to close out their accounts for them. They know if you have bank accounts or a fideicomiso in Mexico, it is disclosed.
The U.S. government just sent me a letter, they're forcing me to close my dollar account.
Yeah, the U.S. government just sent Josh a letter,
So-
even though he works here, lives here, and everything else, they're telling him, we're closing your dollar accounts.
So HSBC called me today.
Even though we
and
report them and we
You
file
have to
them
close.
every year and they know about them,
said, take your money out.
take them out because we're closing your account.
Dollar, not peso, U.S.
So the answer, conspiracy theories, the answer is, they already know about it. And then they want
Yeah,
to
just
just,
file them, they know about it.
so they just want to see if you're following it, if you're reporting it, and if you are, then you're obviously reporting everything else. If you're not, then it's
Bank has a
gonna.
letter.
Did you say they are reporting fideicomisos?
Yes, the U.S. citizens who have fideicomisos or bank accounts,
But
they're required to
banks
disclose
here are
those.
reporting?
Yes, they are required to
They're
report them.
required to.
They are required. So for instance, like for us, we file the forms because Josh and I live here full time and we have bank accounts, right? We're living here. So he and I filed the disclosure form that we have a trust, we just sold our house, but we had a trust. Okay, so we filed that disclosure form and then we filed the disclosure forms for bank accounts. So they knew about those bank accounts. And
Did they know about the trust?
They knew about the trust, and that's not a problem, right? We disclosed it, and everybody was copacetic with it. But, like, for instance, not because of the result of that disclosure, because HSBC had directly disclosed that we had a US dollar account here. The government, as a result of that, not because of the result of our disclosure, we now have to close they're not gonna let us keep it in the Caymans, we've gotta put it somewhere else. So they are reporting it. I mean, because of the fact that the bank reported that we had it there, they've now come to us and said, no, you can't keep your money there, you gotta keep it somewhere else.
They just called me today, I was just.
Yeah, so it is being reported, and it's not because we disclosed it, it's coming from the other way. It came from the bank disclosing our accounts to the IRS. Which is okay, we've reported them and they knew about them,
Just,
but
you know,
it
an
happens.
ironic note, all this came from the Foreign Account Tax Compliant Act from 2010. This requirement of this new form for the IRS and for foreign countries to disclose it. And acronym for it is FATCA.
So,
If you have to report to, even if it's in pesos, if the conversion of it to US dollars is over 10,000,
Pretty more than that, more than 10,000, they
then you don't have to worry about it. You don't have to disclose that.
So you say this transfer from US bank to Mexican bank?
Right. Well, if you're transferring $10,000 out of US bank to anywhere else, they're already reporting that to US Treasury. You know? Yes, sir.
So this tax code was passed in 2010, the trust was in place prior to 2010, and you weren't required to report it until it after it's passed.
Right, this is a brand new form for
There's no
2011. Right,
For your 2011.
right, 2011 tax return going forward. There was certain assets that would have been reported on the FBAR return. As I said, now that they've passed this, they're trying to work it together so there's just one form each year.
I have a question for Amber. Since I can't believe that this could happen because it's so screwed up, does immigration also report people that have FM3s and 2s?
I have no idea.
Okay.
I doubt it.
I mean, technically,
They have their hands full.
no, because I mean, the IRS doesn't care about your immigration status.
Huh?
I don't think the IRS cares about your immigration
What
status.
here, US Treasury, but IRS.
I was gonna say on that 3520, 3528, that's been in effect for a while, but
Right.
that's not a new thing. 'Cause I
Correct.
remember hearing about it, we heard about it for the first time last year from people who lived here before, and so we can go
Right.
back and make up for years we had to file.
For the 3520A, you can go back 3 years just to be safe. You know, statute of limitations before that runs out. But like I said, if you're just disclosing, it's a second home type of situation. And even if it were a rental property, as long as you're reporting your income, that's the main thing they want to know is what you got and if it's generating income or if it's going to generate income, we want to know about it.
One other question. Is there any difference between the Mexican capital gains tax based on your immigration status, being 2, 3, or 0? Is it all the same?
Change every couple of years?
The short answer is that it doesn't matter because they're redoing all of the immigration statuses for next year anyway. So check with me next year. At this point, for you to be tax exempt, for you to be able to tax exempt a residence in Mexico right now, you either have to have your full-time residency card, which is beyond your FM3, it's when you're a inmigrado, or if you are working here with a Mexican for a Mexican or own a Mexican corporation with an FM2. If you are retired, the only way that you can have exemption this year on capital gains tax as a residence, primary residence exemption is if you have your permanent residency card. However, all of those residency cards, FM2s, FMTs, FM3s are all going away and they're redoing them all for next year. So to be determined what the statuses are called as to what they designate which status you have to be. But this year alone, If you are retired, you have to have your full-time residency card. If you are working for a Mexican corporation or own a Mexican corporation, you can have a tax exemption with an FM2, and you are allowed, if you qualify, you're allowed to tax exempt one property every 5 calendar years.
Up to a certain amount of units.
No, doesn't matter.
Pretty much. We just sold our house and I had an FM3 and I work here, obviously. And I had to pay tax on mine.
I didn't, I have an FM2, so
She
my
did.
half was tax exempt,
And I
but
had,
Josh had to pay because he only has an FM3, not an FM2.
even though I've had it for 11 years, doesn't matter.
So,
But if you had your FM2, you
If I would've had an FM2, I'd.
we would have been exempt.
We'd have both been exempt.
So, but those, I mean,
Those are changed.
they're all changing, they're gonna be changing all of that.
Residential, or is that count the property itself?
No.
It has to be a house. It has to have construction, it can't be land.
Sir?
Yes, I think I have a question. You're an American CPA on the Hito,
My parents do.
your parents, and then it's through a Mexican attorney. An average Joe American buy a Hito land and not go through a Mexican attorney.
No, you have to own a Hito land. Let me go back. Hito land is Mexican government property that you have possession rights to. And the only person allowed to have possession rights is a Mexican citizen. So if you are an average Joe, you have to have a very trusted, extremely trusted Mexican national, whether it's your attorney or a friend or whoever, that has those possession rights on your half. But understand that they don't even own the property, the Mexican government does.
Thank you. John, question?
It's a whole other subject.
Thank you for your time. If you have any other questions, I've got my cards up here if you want to email me to clarify anything. If I had misspoken or got a number wrong, I'll clarify it. Yes, ma'am.
The comment about the 5% or the 30% that you mentioned and questioned, what was the answer to that?
You pay 30% of the adjusted gain, less your deductions. Unless you have your permanent resident card. If you have a permanent resident card,
Then it's 5%?
then it's nothing. You can exempt it. As long as you haven't tax exempted another property in the last 5 years.
I think at one time there was a 5%. Thank you.